Welcome, everybody, to the Balanced Wealth monthly webinar. This month, we are talking about 1031 exchanges and utilizing those for those of us that have investment real estate in our portfolios. This is a fantastic tax opportunity for us. Doesn't mean it's always the right thing to do, but in our opinion, understanding these sorts of solutions, the impacts that they may have, and different moving parts of it, so you can understand if it makes sense for you, loved ones, whoever it may be. So with us today, we have Nick Gukin, our Chief Investment Officer here at Balance. He'll be doing the majority of kind of going through in the technical. We have Ryan, our CTO, making sure that everything runs smoothly and we don't have any hiccups there. And then, of course, my partner, Sean Carney here as well, to just pop in, just share some of the direct client experience that both he and I see and make sure that this is conversational going forward. So before I pass it over to Nick to kind of kick it off, I just want to remind everybody of a couple things. One, please ask questions. Just throw them into the chat at any point. Ryan is here to stop us when it makes sense with questions, so we want it to be interactive. And second, we will be recording this and sending it out afterwards, so you don't feel like you have to, feverishly write down notes or anything like that. We'll make sure to send this whole thing out along with the slides are available afterwards. So all that being said, Ryan, Sean, anything to add before we pass it over to Nick and let him do his thing?
No,
If you
not at all.
if you do have any questions, just look for that little Q&A button at the bottom. That's where you'll be able to put them in there. That's
Okay,
it.
perfect. All right. Well, hey, Nick, go ahead and take it away, my friend.
All right. Well, welcome everyone. I'm really excited to do a webinar on this. We've had a handful of one-on-one conversations with folks already, but then we were like, we need to make sure that we get this information out for everyone. So it's just available on demand. And it's one of these areas, just real estate investing in general, that I think we as investors like, because we can touch it, right? That's the number one thing that real estate people like versus the stock market in general. Feels more tangible. You can, lick it, sniff it, touch it. And so this is, I think hits close to home because a lot of our clients do have some sort of real estate exposure in their lives. So investment real estate. So what are we trying to accomplish today? Number one, we gotta make sure we know what a 1031 exchange is. We're gonna go into Delaware Statutory Trusts, which I know that might seem strange considering I don't think anyone on the call lives in Delaware, so we'll go into that. And then, as Bob said, we'll make sure we know when it makes sense to use these strategies and when maybe not to. So if we can check those boxes, we'll be doing good for you guys. All right, so kicking it off here, what is a 1031 exchange? So it all starts with investment real estate. So if you have a piece of investment property, since I drew an outline of a house, we'll say it's a house, and you put some amount of dollars into it to buy it, and then it has since gone up in value from there, you have a gain. So the blue part is what you put in, or the cost basis, and then everything above that is your capital gain. If you don't have a capital gain on your property and you're below water on it, this webinar may not be super applicable for that situation. But we've had a really strong real estate market over the last few years. So most folks do have capital gains in their properties, especially if they've held them for a while. So we start here, and we're going to call this the relinquished property. So it starts by you have the investment real estate, and then you go ahead and sell it with a realtor or however you normally go about selling. And then from there, kind of the next big differentiating step is the funds and the proceeds from the sale go to a qualified intermediary, which is essentially a fancy escrow person. So, but not every escrow person and most title companies and whatnot are not qualified intermediaries. So you kind of have to go out of your way to make sure you're working with somebody who has these credentials. And then from there, you can reinvest the whole proceeds into a new property or replacement property. And just visually looking at it here, your cost basis and the gains that you had all transfer over into the new property. So You're not paying Uncle Sam along the way, paying taxes on that gain. It gets deferred into that new property. So high level, this is the visuals of how 1031 works.
And Nick, if I can just make a quick comment just from, doing these or working through these with clients, that qualified intermediary step there in the middle is so important because you need to identify this prior to closing. You are not able to close on your house or close on your investment property or whatever, and then decide you want to do a 1031 exchange. It is something that must be identified and communicated prior to closing. So the qualified intermediary, very important step for anybody that may be considering this.
Yeah. Also worth noting that we are not qualified intermediaries. We
No.
we work with some. We have a great one that we have worked with for a while now, and is super knowledgeable and great at holding hands through this whole process, because these are usually pretty big transactions, right? And we want to make sure that we do a really good job, and that all parties involved are experienced and know what they're doing with it. So, okay. All right, so a little bit of a background on the 1031 exchange. So a lot of questions we've got recently is like, oh, is this a new thing? And short answer is no. This strategy has been around for, going on over 100 years now. And there's been actually very little changes to the 1031 space. There's been a few conversations or talking points about, doing away with it or etc. But none of that has gained traction. This has been around for a long time. And essentially it refers to the Internal Revenue Code section 1031, allows one to defer the capital gains from the sale of an investment property as long as it meets certain criteria, checks certain boxes. And the purpose and like why this exists overall is to stimulate growth in the US real estate market and economy as a whole. So it's not just, just a tax play with no intent, or like the reason the government hasn't gotten rid of it is because they see the benefits of real estate investing, and they want to make sure that they're encouraging investment in US real estate. So, okay. So what are some of the rules? I know Bob hit a couple there, still stealing my thunder, but that's all right. So number one is both properties must be used for productive use in trade or business. Super generic, like non-specific description.
That's
Which is
that's
by
the
design.
IRS for you. Yeah,
Yeah.
that's for sure.
And so essentially, what counts as investment real estate, it's almost easier to say like what doesn't count as investment real estate. So your primary residence, that does not count. That's a whole different conversation, but almost anything outside of that could essentially be included in the definition of what is investment real estate. So number one, you got to go like to like. You can't sell an investment property and sell your personal residence and have tax-free exchange into a new, bigger home, right? There's rules and regs around all that. As Bob also said, it's got to be disclosed on the front end as a 1031 exchange. So in the closing documents, it has to be clearly marked. You can't go back in time and do the sale and be like, oh, I want to do 1031. It's like, well, too bad. After the closing date, that's your window of opportunity. Got to use the qualified intermediary, and that's probably the piece that I think people miss the most too. They're like, oh, well, I have a great escrow person, or oh, my CPA handles tax stuff, so they'll just be my qualified intermediary. It's like, no, this is a actual designation, actual profession. Whole businesses exist just to do this role. So making sure that we get that one, and also a good one, right? We want to make sure we're enjoying the people we work with. And then kind of an interesting caveat here is the new property has to be greater or equal value to the old property for the full deferral to happen. So again, this kind of goes back to like why 1031s are allowed to exist. It's to stimulate growth in the market, and the powers that be, the IRS, basically figured out that as long as the investing is continuing to go upstream versus downstream, like in the lesser expensive homes, then it will continue to push the market upwards. So interesting caveat there. There's a few ways kind of around that too, we'll get into. And then interesting rule that kind of goes hand in hand with the qualified intermediary. But from the time that you get the funds in the qualified intermediary's hands, you have 45 days to identify a replacement property, whether that's another house, whether that's self-storage units, or whether it's something else. 45 days to identify, and then from there you have 180 days to actually close. So it's a relatively short window of time. We know how fast life goes, and that 45-day timer starts ticking. So that's one to keep in mind. This is a timely thing here.
And I think from a practicality standpoint, it's one of the areas that a lot of people are excited to do this. And then when they actually go to kind of execute, they get so caught up in the timeline that it just kind of the deal just falls apart. So it really works out well when you know exactly what you want to do and you've decided that you're ready to move forward and you're trying to defer the gains. When you try and do this after the fact and say, hey, I want to sell my investment property. Hey, what if this 1031 exchange thing sounds pretty cool? Let me do that. It almost never works out. So understanding that, hey, I've got this vacation home in Tennessee and I know I want to buy a place in Florida and I know exactly where that is. That may be a great time to start thinking, okay, let me plan this out. But if you make this as an afterthought, it's probably going to be too late to kind of go through that process. Everyone's been through a real estate transaction that, you thought the deal was done and then it gets, canceled or financing doesn't go through and the whole thing falls apart. And then you're like, now you start to panic, like, oh, I've got to get this done. And you start selling on a property. So I think this is one of the areas that the rule kind of, prevents people from actually executing this on a practical standpoint. And I think it helps kind of understand the best ways that you can start to think about using this.
Yep.
Related to that, we did have a question come through. Are there ever any extensions granted for those deadlines, or are they just hard deadlines? Can't get any extensions on them.
Yeah, those are hard and fast deadlines there. I think the only exception that I know of is if the house that you're selling is in the declared like natural disaster zone. So if there was a hurricane that came through or something like that, you can get up to an extra 100 days or 120 days, about 3 months. So that's it. So don't plan on there being a lot of grace period here. All right. So now let's get into some numbers. I have two examples here. The first one is on this slide, and we're going to go through, and it's a $350,000 property. And the question is, does it make sense to use a 1031 exchange when it comes time to sell it? So in this case, say that it was purchased for $250,000. It's now worth $350,000. So by the time you go to sell it, and let's just pretend that realtor fees don't exist and you walk away with $100,000. So from there, if you don't do the 1031, you're going to pay federal taxes of your could be capital gain rate, whether you held it for a short period of time or long period of time. We can assume it was a year or more. So say it's the 15% bracket. And most states actually tax capital gains as well. So Colorado and Ohio, which I know are most of our clients are around that region, those states, they would also collect the state tax on top of that. And so net proceeds would be 81,000, net profit would be 81,000. So then what you walk away with would be 331. Versus if you did the 1031, then all of a sudden you get to skip paying the tax man and that whole profit just gets to roll into the next property. So not too crazily exciting in this example, but hey, you've got 6% more to invest. 350 is better than 331. So we'll keep going on there. Yeah, go ahead.
We do have a question, Nick, to this example. Are there any fees charged by that qualified intermediary that would erode this at all?
Yeah, so the qualified intermediary, at least the one that we've worked with before, charges a very reasonable, low flat rate fee. I believe it was like $800. It kind of tiers off depending on the size of the deal,
Yep.
but
Yeah, it's we just
$800
went through
for,
this. Yeah, we
yeah,
just went through this, Nick, and it was I think 895
okay,
for kind of under a million, and then over a million it goes up to like $1,200 or something. It's very reasonable relative to the dollar amounts that we're talking about. But there
yeah,
are qualified intermediaries, just as an FYI, that some of them charge like a percentage of the transaction or something along that. So make sure as you're looking through this and vetting out qualified intermediaries that you're getting one not only that is going to do it right and going to do it well, but also has a reasonable pricing structure that you're aligned with.
yeah. Great question.
Very good
Great
question.
question. All right. So next example here is, let's say it was $1 million property. And let's say that you put in $100,000 originally, maybe 10, 15 years ago. And now it's worth $1 million. So that means when you go to sell it, you have a $900,000 gain. That's a little bit different calculus than what we just talked about. So then we can really start to see the differences and the benefits of these 1031 exchanges. So in this case, and kind of more realistic too, people with investment real estate usually depreciate it to get the tax benefits. So you have if you just did not do the 1031 and just sold the $1 million property, you'd have to pay back the depreciation recapture. You have the federal taxes, probably at the higher tax bracket at this point, and then you also have the state taxes, like we talked about before. And this also bumps you up into the net investment tax or the Medicare tax that kicks in as well. So you walk away with, $712,000 versus in 1031 land, you get to walk away with $1 million. So that's a lot different. That's, depending on which way you go with that on the calculation, 30 to 40% more that you get to invest in this type of scenario. So the dollar amounts do make a big difference, especially because the way the tax brackets are designed. But also it just really moves the needle a lot more on tax planning just with the bigger dollar amounts. So
And I think too, one of the things that we always see is the depreciation recapture always shocks people.
yeah,
So if I'm taking depreciation on an asset, then I'm getting that federal tax deduction off my income. When I sell that asset, I have to recapture all those deductions. And normally that's at my ordinary income rate, but there's a special clause for real estate where it's only 25%. So that's one of the ways that real estate can help with some of that depreciation recaptures. You're not paying back a full tax rate of say 37% if you're in the highest income bracket. So
Yeah.
that's just a powerful advantage of real estate.
yeah, yeah, absolutely. So it's like, this sounds like a great deal. Who doesn't want 30 to 40% more? Surely there are limits on this stuff, right? Like everything we talk about in our world and investment world always has limits. Like there's a limit how much you can put in your 401k, there's a limit how much you can put in a Roth. But in 1031 land, there's actually no limits. So no limits on how many times you can do an exchange with the same dollars. You can just keep snowballing it. And there's no ceiling on the dollar amount that can be deferred either. So these are very attractive strategies, the same strategies that folks use for, and the example one, maybe $100,000 gain. The same exact tax code applies for $100 million gain. So these are definitely interesting strategies, and they apply to a very wide range of people because of this framework. So, okay. All right. So there's no limits. You can walk away with a lot more. But what if you don't want to be a landlord forever? That's really the question that we always ask our clients, right? Like maybe it's working out great and you have amazing tenants, or maybe your tenants are your family members. So good luck with that. But in cases that it doesn't always work out, or the headache becomes more than it's worth, what are your options? And I think kind of boiling it down into two scenarios here is great. Number one, pay the taxes and move on, right? Like that's always a viable option. In some cases, it may make sense to do that and not worry about this 1031 conversation. Maybe that's the right move. But also, you do have another option that applies for not being a landlord, and that is looking at doing a 1031 exchange into a DST. We love our acronyms in the financial services industry, so we'll unpack it a little bit. So what is a DST, or a Delaware Statutory Trust? So the reason that this is important, and this is again very high level kind of definition here, but the IRS recognizes DSTs as like-kind replacement for property. So what that means is, investors with real estate, you can sell your physical real estate and exchange the value, the proceeds, into a fund or a pool of professionally managed real estate. So if you all of a sudden aren't fixing toilets and pipes anymore, now you're just a passive investor and you have a full-on professional team that's managing different set of properties. Okay, so big visual learner. So what does 1031 DST transaction look like? Very similar to a normal 1031, right? Like you have your house that you sell, the proceeds go into the qualified intermediary. But instead of going into another house, you go into the replacement property that's professionally managed. So same exact steps apply. All right. So I love this slide because it really just helps visualize like Delaware Statutory Trusts. They're like, oh man, I have to set up a trust now. This sounds so complicated. Maybe I don't want to do this. And this is also an excuse to throw Mach 1 Mustang on the presentation. So anyway, the way I like to think about investing in general is that there's always the chassis, or the body of the vehicle itself. And so whether that's an exchange traded fund, which many of you are familiar with, or a mutual fund, interval fund, a Delaware Statutory Trust is the same thing. It's just another type of vehicle. And what is almost equally important to that is what's under the hood of that vehicle. So within exchange traded funds, you could have stocks, bonds, real estate, etc. But what we're talking about today is the vehicle is the Delaware Statutory Trust, and then the investment strategy within it is real estate. So these are just additional investments on the menu, so to speak, or tools in the toolbox. But conceptually, this is how it fits in. Okay, so what does that look like going into this 1031 DST? Here we go. So we start with the house, same capital gain. So immediately at closing, the funds go to the qualified intermediary. From there, we have that 45 to 180-day window to find and close on the replacement property. But in this case, it's the DST itself, the 1031 DST fund. And then from there, a few things happen. Number one, you start collecting monthly income from the fund, usually in the 4 to 5% range. Sometimes it's higher. We'll go into that in a little bit. But the interesting thing with these kind of traditional 1031 DSTs is they have a lifespan or life cycle. So, and you usually have a pretty good feel for what that's going to be on the front end, though it's not like guaranteed. So they can go as short as 2 years to as long as 10 years. And while you're in there in the fund, you are locked up, right? Like you can't just sell and take all your eggs and go home. It's locked in there, but you are collecting like rental income from the fund. And so when it matures, you have two choices. You can either cash out, take your chips and go home, pay the taxes at that point, or you can go back to the qualified intermediary and do another 1031 exchange. So the cool thing with this is you can go to the DST, and then after it matures, you can actually go back to normal investment real estate. So like say there's a great property for sale in your city, in your neighborhood that you want to execute on. This would allow you to kind of pivot from physical real estate, being a landlord, not a landlord. And if you were crazy enough to be a landlord again, you could go back and do that again if that's what was right for you. The only thing I'll say on this is these are actually not all or nothing. So you don't have to do 100% of the proceeds has to be deferred into another deal. You could take half of it and just pay taxes on half of it when it matures, and do the 1031 exchange with the other half. So still has some pretty good flexibility. The lockup and the time period with that, the 2 to 10 years, that's probably one of the most different things versus the normal stock and bond investing that we do for folks. So making sure that we're not getting ourselves too crunched on the liquidity side will be an important piece of the planning conversation. Okay.
And just as a side point, Nick and Sean, just to speak to something you mentioned earlier, this DST solution is something that sort of fixes that problem if you can't find or didn't find or something falls through with like a specific property, that you can always go at day 44. There is going to be a DST offering available that could house the dollars. So this helps to offset some of that rush or risk. And also sometimes what we've seen it used for is, say you sell $1 million property and you want to redeploy all 100 million, all million. But you only find a property that you love that's 750,000. What you can do by utilizing a DST, and Nick, correct me if I'm wrong, but you could buy that $750,000 property and put 250 into the DST. You've redeployed 100% of your capital, continue to defer it, and now you just have a couple of different real estate holdings. It's a really nice benefit of the flexibility here.
Yeah,
I
absolutely.
would also caveat too, like it's a good opportunity for if you're in kind of a high income year, maybe you just sold your business, so you're going to be high income, but your taxes are going to be lower in 2 to 10 years. And so you may say, all right, let me do this DST. I know I'm going to have some type of real estate investment, but now that I know I'm in a lower taxable income, maybe now it's the best time to, kind of realize some of those capital gains.
Yep.
Yep. Absolutely. So I love what you brought up, Bob. The DST framework is almost like just a puzzle piece. Like it can fill in a lot of different gaps in the plan. So whether that ideal property maybe falls through, or you have 2 or 3 houses or properties that you're buying, and then you use the DST to fill in the rest of the pot, so you can continue deferring. There's a lot of great use cases for it. So okay, so
question.
Yeah.
We did have another question come through as well, Nick. Are there time restrictions or deadlines if you go to a DST that expires and then you go back to the traditional 1031 exchange? So that 45 and 180-day timeline apply again after you get out of the DST?
Yep, exactly. So once you go knocking on the QI's door, that's when the timer starts ticking. So yep, same time frame applies. And and if the other thing too is, like, if for whatever reason it doesn't work out and you can't find a deal within that time frame, it's not like you're penalized or anything. It's just you pay the taxes, right? So it's not like a whack on the wrist or anything like that. It's just pay the tax.
Like an extra.
Hold on.
Yeah, there's not an extra penalty outside of paying a qualified intermediary for their work to hold the money for that time. There's no additional penalty if you don't kind of follow through with it.
Yeah, exactly. So more like, so if you're even considering doing a 1031 exchange, it's almost worth it just to put the funds in the hands of the QI, just to give yourself a little bit more breathing room and flexibility to make a decision. And worst case scenario, you walk away, pay the tax anyway, and you're fine. Missed a month of interest, you'll be all right. So okay, so just kind of like, I wanted to illustrate, like, what does the cash flows look like? And I kind of picked up on that same scenario of the $350,000 house, just to like sequentially go through what does it look like. So say you sold the $350,000 house, and you're going to move the whole 350 to a 2 to 10 year commitment in a DST. I picked 7 years, just to kind of making it a little more on the high end. I think it's a little more average for these as well. So the dividend yield, and you get to know this again on the front end of the deal, is around 4%. And so percent of 350,000 is roughly $1,200 a month or $100,000 of income over 7 years. And then what's kind of cool is at the end, when this matures, the DST, sorry, excuse me, the DST has to sell the property at current market rate. So depending on what the market's doing, and if the market's just kind of gently gliding up over time, which is very common with commercial real estate, depending on the segment, maybe not office buildings, but there's a good chance that you collect extra capital gains in this fund as well when it matures at the end of the period. So you wouldn't be collecting interest and gains along the way. It's more you get the dividend income all the way, and then at the end when it matures, you may have even more capital gains to consider deferring or paying taxes on. Not a bad problem. It's just worth noting. So, okay. All right. So, keep going along here. This is not that we're recommending this or anything, just as kind of a real life example of what's available just off the shelf today in the 1031 DST land. So this is a student housing property with 84, almost $85 million worth of availability. This one has a minimum of $100,000. If that makes sense. Again, that might be more of like a fill-in situation if you're in the $100,000 range. But the current yield, or what they would expect on this, is about 4.5%. So it's 4.5% income, and then who knows what it'll be worth at the end of the timeline there. So just worth noting, these are real properties. Usually when we're talking about stocks and bonds, it's like seems kind of out there, like up in the clouds. But this is like a real property with a real address. You could go and touch it and be like, yeah, I own a small piece of this land. Okay. All right. So that's kind of the more traditional route on how 1031 DSTs are used. But there is some other options, at least one other option I will talk about today. And that is called a 1031 to 721 exchange. IRS loves their codes. So what does that look like? We'll break it down here in a good flow chart. So again, starting with the same house, with the same cost basis and capital gain, same process, you immediately move it to a qualified intermediary. You have the same timeline to move it to a DST. So up to this point, everything's exactly the same. So then here's where it gets a little different. This DST, and you know this on the front end, so it's not like a surprise or anything, but this DST after 2 to 3 years is scheduled to get absorbed into a jumbo REIT. So what we just saw in that last example, like that was a student housing property. It's a single complex or single building in that example. But there's REITs, which are collections of properties all over the country that are always hungry to absorb these properties. So at the end of 2 to 3 years, it gets acquired or absorbed into a large diversified REIT. And then the investors receive shares in the REIT, where the official word is OP units. And then from there, and meanwhile, let me just kind of back a bit. You're still collecting that 4-ish% yield all along the way here. So it's not like you're not getting any returns along this process. But then once it moves into the REIT, you have to wait 12 months for the full tax deferral and everything to shake out. But from there, you have fractional liquidity in your real estate, which you never had before. So you went from an investment property where if you ever wanted liquidity against it, you'd probably have to take out a loan, and you're dealing with that, which may or may not be a great option. But now you're moving into the land of, okay, I have just share-based ownership in a REIT that I can get monthly or quarterly liquidity from, where I can sell it and pay the taxes at that point, if that makes sense. Or you can just own it into perpetuity and forever. And this is where the kind of the estate planning piece comes into play, where it's like if you can hold this fund forever and defer those capital gains up until your death, then your spouse automatically gets a full step up in basis upon your passing. So that still gets the same benefits of normal investment real estate, which is great. And it's also can be liquidated then at that point, or she can continue to hold it, or your spouse can continue to hold it until it makes sense for her to liquidate it or not. And then it can just be passed down to the heirs from there. So this is kind of really, really cool tool from a planning perspective. And also it's how you can very quickly go from fixing toilets to fully passive ownership in a giant nationally diversified pool of real estate. Okay.
Yep. Yeah, Nick, just from a financial planning perspective, I know you touched on it, right? But from a, one of the big difficulties with real estate, obviously, is you can't take it to, you can't sell a portion of some rental property or office building or whatever to go buy groceries or go on vacation with your family or whatever. This here is a great mix of both worlds where we get the best of what real estate has to offer, right? Which is a lot of the tax benefits and the deferrals and all that, but also picking up that very important fractional liquidity where then we can make the decision. And again, this to me, this always goes back to the financial planning point, right? Like, how do we tie this in with all the other things that we talk about, from investments to, income planning to Social Security elections to Roth conversions to whatever it may be. This can be an important component and offer a ton of flexibility while still deferring that tax.
Yeah, yeah. Not like you could go cut off a piece of your yard and sell it to go buy a car or pay for something, right? So yeah,
Yep.
this is cool flexibility here. All right, so keep going on. So we're gonna pretend, go back to that same $350,000 house, and let's see what the 721 exchange looks like. So you put it in, and for that 3-year period, you're in a normal DST where you're collecting that, call it 4 to 5%, could be more, but we'll just be conservative, 4 to 5% of yield there. And then after 3 years, let's say it gets exchanged into the 721 or into the bigger REIT. So from there, again, you kind of start collecting that 4 to 5% return range when you're in the bigger REIT. It could, of course, be higher than that, could be lower than that. Real estate market is not always a straight line, as we've seen in recent years. But the cool thing is, it can be held forever. You can sell pieces of the REIT when you need liquidity, and then you just pay taxes as you go in that scenario. So it's less of like a giant big decision like if we go back to the other scenario, every 5 to 7 years or whenever. This just gives you more hands on the control. You don't have to worry about keep continuously rolling DSTs as they mature. So kind of the perpetual choice. Okay.
Yep.
All right. So, and again, just to prove like this is real property that you can go and touch, this is an example of an open 721 DST. So this one is in Ann Arbor, Michigan, go Michigan. So I had to include it. And
Gross.
kind of the same story there. These usually do have a little bit higher minimums than a traditional 1031, usually in the 250 range, but most people with investment properties, it's not too hard to surpass that. And you can kind of see the return expectation that they're showing out of the gates. So, okay. All right. So again, we do not run DSTs, just like we don't create ETFs or mutual funds, but we work with a handful of providers who do. Some of these, like Inland and Aries, I think are the two. Between them, they're definitely some of the biggest in the country. Origin is another kind of newer one. And so depending on your time frame, the dollar amount, et cetera, we may be using one vendor versus another, but we are independent from them. We're not beholden to them. There's no like kickbacks or anything like that. We truly just work to find which provider will give you the best investment outcome that best checks all the boxes on your list. So, Okay.
We did have another question come in here, a little more of a specific circumstance, Nick. So
Okay.
we have a rental property that we are thinking of selling to buy another property, but it will be used by us on occasion for vacation, but more often for short-term rentals. Would this qualify for 1031 exchange?
I think short answer is yes, especially if you have a whole business behind it and a whole like you're filing taxes on it regularly as a business and all that. Like those are really the key things that the IRS looks for. You're allowed to step foot into the property that you own and enjoy it for a minute, right? It's more just the folks who make it as a pure vacation home and like they're not renting it out or there's nothing or they're reporting it as a secondary residence and not as a business or investment property. That's where it gets a little hairy. Okay. Great question though.
Yep. And not to muddy the water or anything, Nick, there are ways that you can eventually make it a primary residence, but there's some waiting periods there, and you have to have had the intention for it to be a investment, right? You can't just go in and say, hey, I'm going to buy a new, secondary property. So again, there is nuance to that question. And if I said that incorrectly a little bit, but there is nuance to it. But yeah, you don't have to feel like you have to completely not be able to enjoy the space at all.
Yeah, yeah, exactly. So, all right, keep going along here. Here, we'll just hit you with some pros and cons, kind of stir up some conversation here. I know this is a lot. It's kind of like supposed to be a lot, right? Like there's a lot of different options that you have when you're selling investment real estate. And kind of the first option that we look at is what if it makes sense for you to just buy another real property like around you? And we are happy to help you navigate that and see if that makes sense. If anything, like what we talked about today, these 1031 DSTs and whatnot, just help give you almost like a mental benchmark. Like, hey, like, is all the headache really worth it, or should I just go with the passive option? So, but we're happy to help you weigh the pros and cons of that. I think, like, from a total return perspective, if you're out there flipping properties and putting your own sweat into it, or fixing rentals or managing tenants by yourself, like those are probably the highest dollar return options. Putting your own sweat and time into it, but there's a cost to that too, right? So I'd say some of the interesting things, or if I look at the cons across all of the things we talked about today, is it's not guaranteed, right? Like we have a lot of confidence in the real estate market in this country, and rates are coming down. Real estate market should look even healthier and more rosy in a year from now than it is today. But it's not truly guaranteed way to solve for total return or solve for income, etc. So just know, like, we do have some things on our menu in our investable universe that are truly guaranteed. And we also have things that we think can return a lot greater than what we showed today as well outside of the real estate world. So sometimes it might make sense to sell it, pay the tax man, and then you can invest in anything you want, right? Whether that's stocks, bonds, other private investments, or insurance, whatever makes sense. But making sure that, like, we just kind of understand or ask yourself, what am I really solving for? Is it really just income that we're solving for, or is it something else? And so I think it's a good place to start. Yeah, I saw
I
you came
think
up.
too, just to highlight some of that. So real estate, right, historically as an asset class breaches at 45%. Nick kind of showed some of those percentages that they expect to get that return. But property, right, especially commercial property, when everyone works from home, can take a loss. So when these DSTs make their sales pitch, they say we expect about 4%. But as Nick alluded to, that can go up or down depending on how the investment does. So a lot of times those REITs come off as like a guaranteed thing, and we don't want you to take away that that's true, right? If that senior living home is poorly managed, right, that asset class could go down in value and could not return any, monthly payment, or they could, dominate and end up sending you 8-9% a month. So those things are not guaranteed when you're doing it. So having that conversation because sometimes paying taxes and just putting in the market passively is a great choice. So it's going to depend uniquely on everyone's situation. That's what we're here for, to kind of explore different options with you.
Yep. And Sean, you couldn't have said it better, right? Like, the fact that there are a lot of different ways to invest. This is just one of many. And I think the important thing and what we always try to do for our clients is what makes the most sense overall. And we don't want to just have taxes being the reason that we're choosing an investment strategy, right? Like if that's the only reason we choose something, it's probably not the best thing, right? It certainly is an important consideration and it factors into the overall plan, but let's not have that be the only thing that's controlling the decision. But again, just to tie this together from a 1031 exchange perspective, this is a great solution if we can, afford it in all other shapes or places of our financial plan. But let's not only have taxes be the only part of the combo.
Yeah, yeah.
Yep.
That's well said. Well said. Every investment should be able to stand on its own merits, like outside of taxes, right? Like it's
Yes.
got to independently be attractive. So, and real estate historically, has had some really good runs, has had some tough runs, but mostly it's been a differentiator, different performance from stocks. So it can still add to the diversification of the portfolio. So, all right. So, I'd say like the biggest piece there is that if you're paying the tax man and just walking away from real estate in general, then you just almost automatically have a mental, or you can have a mental like benchmark or like hurdle rate, right? Like if you paid the taxes and whatever you do next from purely investment, forget the planning and like all that stuff, but from purely investment perspective, it's like, okay, now we have a hurdle rate. Like what does it make sense to reinvest in that's going to get you back to break even the quickest? And again, we're happy to have that conversation with you guys too. So, all right. Any more questions on this?
Yeah, I just saw one come through. Did I hear correctly that this can only be used for property in the US?
That's a great question. I think in general, the answer to that is yes. There's different, once you start going outside and of the borders into different countries, like I think you're definitely going to look at being subject to international taxes, right? Like that's like if you go in just for round numbers, had that $1 million, $900,000 gain in Mexico, and you're like, oh, sorry, Mexican government, I'm gonna defer all these taxes and move it all to the US. Like they're not gonna let that fly. So I would plan on paying taxes in other countries for sure. But that's
Yes.
certainly a much more complex tax conversation. So
I've got a question for you, Nick. Just because I have never done like the UPREIT.
mhm,
So if you get to one of those, you talked about like liquidity is sharing off, selling off a couple of the pieces. Is that
mhm,
like a publicly traded REIT? Is that private? What kind of
mhm.
liquidity is guaranteed versus, hey, our story is, yeah, you'll get liquidity whenever you want. But
Yeah.
ultimately, we've seen with REITs that they just say, maybe once a quarter we'll offer a liquidity event.
Yeah, yeah. So there's of the three different 721 REITs from those three different providers that I've looked at. They are all private REITs, so they're not publicly traded or anything like that, like a stock on the stock market. And that I think does help them gatekeep their liquidity or manage their liquidity better, right? Like they don't want to um, have so many redemptions that it hurts the business. That's really why they have those parameters in place. And so, but yeah, to your point, Sean, like it's not guaranteed liquidity, but that's essentially, they have a good track record of providing liquidity is ultimately why you would go that route. And that's the structure. That's what it's intended to do. So, yep, great questions. All right. So just to continue to bring it all together here, you've probably seen this slide before if you've talked to us before, but we like this funnel because at the top, there's everything there is to know about investing. And that's the whole investable universe. And even though we think we know a lot, we do know a lot, we'll never claim to know everything in the investable universe. So as we whittle it down to investment ideas that the advisor understands and can implement, that's still, I think that us at Balance Wealth do a really good job at that and have a much more broad, diverse set of answers and solutions than most folks. But even if we take it a step further, it's like, okay, we have all these ideas, but what makes sense for you, Mr. and Mrs. Smith? And that's where we whittle it down even further into investment ideas that you understand, trust, and align with your goals and values. So if we can help kind of guide it all down into that and how it applies to you and your specific plan, then that's what we call the perfect investment strategy. It's not the one that's, rolling it all or throwing it on black or anything like that. Like we take thoughtful bets, thoughtful investments, and make sure it applies in the right way to your life. So.
Awesome. Well, as we just wrap up here this afternoon, if there are any other questions for anybody that is on the call here, feel free to drop them in. But I do want to just say thank you, Nick, for not only putting this all together, but just doing such a great job of walking us through how these 1031 exchanges work, what they mean, and how they can tie in to an investment strategy. And I'll just say this as a follow-up for anybody that's either here now or going to watch it in the future. Feel free to send this along to anybody that you think may find this helpful too, right? Like, may not be you that has some rental real estate or investment property, but you may have a friend, family member, parent, sibling, whoever. Our goal here is to make this very educational so that he or she, your friend, that person that's close to you, can understand all the flexibility and options they may have. So please feel free to share this. We'd love and appreciate that. But are there any other questions or anything before we wrap up here, Ryan?
I think we had one more question come in.
Okay.
Not sure if one of the words here is right, but I'm just going to read it as it came through. It says, how real is the 1031 addiction once you get into depreciation and accelerated depreciation to offset W-2 income? Is it hard to stop this once you get started? I've heard this from several people who are in the 1031 game.
I think that is the right word. I think
I
addiction
think
is the
so
right
too.
word there because I get it now that I hear it out loud. But
Yeah.
go ahead, Nick.
Yeah. I mean, it's probably like the only investment or one of the only investments that doesn't have limits on it, right? So, for people who might be addiction prone, having no limits could be a slippery slope. I don't know how a better way to put it, but I think it's a great tool. And I think eventually, even if you keep snowballing it, like eventually you probably come to a point where you're like, okay, I've created a big enough nest egg. I'm cool with being nationally diversified, right? Like they say, building wealth is in concentration. And then once you've built the wealth, then the next step is to diversify to keep it. And so
Yep.
I think this is kind of the end of the road for a lot of folks. And as far as the next step in being a successful real estate investor. And also, I would say like a lot of people have a realtor friend. I mean, there's a lot of realtors in this country. I think everyone's probably friends with a couple of them, but most realtors don't know that something like this exists. And I think if they did, they would realize that there's a lot of properties that are like locked up or people don't think they can sell them because of taxes and capital gains. And so I think there's actually a huge market opportunity for realtors to come alongside and help people exit those big positions and have that investment, have those dollars better serve them by working with an advisor, by working with us just to show them, what some other options are. So.
Yep. Awesome. Yeah, I know just generally the ability to leverage the tax benefits of real estate can be addictive. People that are in real estate love real estate, and it can be a great area, but I always go back to ROH, return on hassle, right? How much of a pain in the butt is it for the return that you're getting? So again, this is a great way to follow through and carry through that real estate side of things, but it's how does it ultimately get back to you for you, your family, getting groceries, all the stuff. So, yep.
Yeah.
All right. Well, hey, I think that's everything. I think that's all the questions. We're just under an hour here. So, Nick, congratulations on not going over the time. So that's always a big test for Nick. But want to thank everybody for being on here this afternoon. Sean, Nick, Ryan, thanks for being on here with me. And, we will get this recording out for everybody. And we look forward to seeing everybody next month at the Medicare planning webinar as well. So thanks, everyone. Have a great rest of your afternoon.